Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 15th, 2019. As we head into the weekend, I wanted to do an update on gold. Had an inquiry from a member in the trading room, asked about my thoughts on GC, gold futures, which I shared, and I'll share again here. And I stated also to that member I was going to post some charts, but I figured there are enough developments in gold right now, things worth noting, as well as the other precious metals. So we're going to go through as quickly as possible the charts of gold via GLD. We'll look at gold futures quickly, silver, platinum, palladium, and of course, in my opinion, any analysis on gold is incomplete without looking at and confirming or refuting that analysis. If you can't make a strong case with the outlook for the US dollar. So we'll cover all those and let's start here with gold. Now, lately, it's been in a clear uptrend, at least since last fall. You can see, gold making a series of higher lows and higher highs, and that's simply the definition of an uptrend. When we exited, here's that last trade. I have it right here. We had the last official trade on gold. We did a swing trade as well as what I call a long-term trade. It's the same as a trend trade. Those are trades that I expect to last for at least several months, sometimes years or more. And I still plan to get back into gold at some point soon for the next leg up. I remain longer term bullish. The only thing is my near term outlook, just as back then when I updated that, when the target was hit, I clearly stated I thought the odds were pretty good for a reaction or a pullback. Hence, I didn't extend the targets. I closed out this trade, and that's what it was. It was gold has been dead money since. Now, it's starting to perk up here a little bit, but the high was still there. We exited on the 29th, and it peaked 2 days later, and you can see it's just been a dead money trade. And because gold doesn't pay a dividend, it's not something you want to sit in if you can, possible, if the charts really indicate that you may have some consolidation like this, you want to step aside and not get caught up in that, if possible. Depends who you are. If you're long term and you put it away, when at the time I didn't see a compelling reason to sell out of any long term positions, and I may have stated that, but as a more active trader, that's what I'll do, and I'll always share my thoughts when I close a trade out as to whether I think it may have more upside or whether the odds are pretty good for sometimes I'll even clearly state a lasting trend reversal. And that wasn't the case here. So if I don't mention that, you can always just drop me a line in the trading room, and I'll be glad to give you my 2 cents for what it's worth. Okay, and before I go over the technicals of gold, let's just look at the longer term view. And no, let's do this. Let's jump over here. Yeah, we're going to get to this long-term chart because this tells me a lot, and this really helps to formulate my longer-term outlook for gold, of course. It's a 10-year weekly chart. But I wanted to cover one thing real quick with you. This is a 10-year chart right here of gold in the white line overlaid with the S&P 500 in green. And the point here is gold is often used as a flight to safety instrument. That was part of the basis for our trade, our long entry back last October, when the market had just rolled over and I was expecting a lot more downside, and the market hadn't responded to that yet. It hadn't priced in the correction. They were shrugging it off. There were too many non-believers, especially with the pros, because I didn't see, it was documented in the papers at the time as well after I said it, gold and treasuries were not rallying. But we got into both at the right time because what'll happen is the market starts to go down enough, you're going to get that panic, and that's what you did. They finally started moving out. So again, we'll get back to that trade in a second. But the point I'm trying to make here, not to digress, is that there are times when there's a very strong correlation. Don't pay any attention to the differential. In other words, I'm pointing arrows. I'm showing you the stock market and gold moving up both at least, well, I should clarify here, to about this point. If you want to be pretty accurate, you can see a rally in both up to here. Remember, you're looking at just the direction that each are heading. They're not priced in the same units, so these charts aren't going to mirror each other. But then you have periods where there's a disconnect. And in this case, the stock market continued to rise all the way up to this point, why there was a direct inverse correlation. So we went from a highly positive correlation to a highly inverse correlation in gold. So I just want to point that out. There's really no rhyme or reason. Sometimes they're both moving together. I mean, there are factors, don't get me wrong. And then other times they're not moving together. So We can't really rely on this, but there is one constant, and this is why I always put the analysis of the US dollar in my gold analysis. I go here, edit chart properties. Let's just overlay, take off the S&P 500, and we'll overlay. I thought I had them up here. Either way, we'll just replace it here. We'll look at UUP, which is a US dollar index, and we'll look at UDN. Let's just put in UDN. There's a reason for that. UDN is the inverse dollar index, so we can get rid of SPY now. So we'll start with UUP, and well, you can put UUP. Now, the reason I use UDN a lot is, I do this. I'm a chart hound. I'm also a very visual person. I'm just, things jump out to me, whether it's stock charts or things out, if I'm out, hiking in the woods or something, I'll spot things that people always, a lot of people don't see, and they're like, where do you see that deer? Where is he? And there he is, right there by the trees. So when I look at this, I can clearly see the inverse correlation. I know all eyes might not see that right away. So when you flip it upside down, the dollar index, then you can see the correlation if it didn't jump out at you before. So that's why I'll use UDN. And you can see now, since UDN is the inverse dollar, because what I'm trying to say here is the US dollar and gold have an inverse correlation. One goes up, the other goes down. So when you flip the dollar around, you'll see then we turn it into a positive correlation. And again, there are, like with any two asset classes that are correlated, have a strong correlation, there are temporary periods of disconnect. But when you go back 10 years, this chart is unmistakable. And again, just look at where they each peak, and you see that they move and fall in unison. Now, listen, this is not rocket science. This isn't some magic formula. This is plain and simple. Gold, at least the gold we're trading here in the U.S., if you're in the U.S., or you're buying GLD on an exchange, those are shares of gold based in the U.S. dollar. Based on, the currency is in the U.S. dollar. So therefore, if the dollar depreciates by, let's say 50%, it's going to take twice as many dollars to buy 1 ounce of gold, all other things being equal. And all other things are the supply-demand constant. You hold that constant. If there was, same demand for gold, same amount of gold out there, and the dollar fluctuates, that's why it goes up. So when the dollar falls, gold goes up in price, and when the dollar goes up in price, gold falls, because then it takes fewer shares to buy it. Okay, enough on that, but I think it's important to know not only that there is a direct relationship there, an inverse relationship, but why it is and how that works. All right, so back to the chart of gold. This is a long-term chart, and again, this one speaks volumes to me. This is a big symmetrical triangle pattern. Gold, we had the bull market back there leading up to the 2011 highs. We had a bear market down to the it was actually in December, late 2015 lows, and what appears to be a new bull market, not as vigorous as the last one, but so far we're making a series of higher lows. Now, here's the thing. We don't yet have a series of higher highs. I'm just circling the two major reaction highs. They're roughly equal. So this is the big level we need to pop, 130.05, and when 130.05 gets taken out, which I think it will eventually, then we can will probably be in a more vigorous, move up, something similar to this. And if you look at it this way, there's a lot of, basing, if you will, a lot of trades going on in this range right here. And one way or other, gold won't trade sideways forever. It's going to break above or below this range, and we'll have to look at it objectively. If it breaks down below the symmetrical triangle impulsively, that's not going to be good. As of now, looking for an upside breakout, and I can move that line up there if I'd like, hit this high, hit that reaction high, and just clip that one. And now what this does is it puts us right on the trend line. So there's still a little caution I have on gold. We call it caution or call it whatever you want, just that we need a little more evidence to really help firm up the bullish case. Number one would be an impulsive break to put this trend line in the rear view mirror. And I'm talking not on a daily, but at least a weekly basis. So print a couple, 1 or 2 weekly candles, get up here somewhere away from that trend line, and then ultimately come on up here to 130. And then again, if we break above that 130 level in GLD, It's pretty thin all the way up there at about 151, and I would put that as a pretty high probability long-term target. So that's the longer-term outlook for gold. My personal preference normally, although I'll trade gold futures because of the leverage, but gold is you're not gonna make a ton on a trade in gold if you're taking a normal position size because it doesn't move that much relative to the stock market or certain stocks or other commodities. So you either leverage up on gold or you trade the miners, and the miners, in my opinion, are simply, I always refer to them as a leveraged play on gold. And that's how it works. When gold goes up X, they're going to go up 2 or 3 times X. When gold drops X amount, they're going to go down more because their bottom line is largely dependent on the price of gold, of course. So that's the long term. Let's not make a long term chart. Let's not make too much of it. But before we leave it, let me just point this out. The RSI, you can see, is at overbought levels, a 70 level, as it was almost here, and as it hit here and here and here. We had a couple of oversold readings, and they proved to be buying up. So typically, this is when you want to be selling your gold or going short, and this is when you want to be going long. Obviously, it's not the most objective time to go long here. However, that is under the assumption, although, like I said, can't say definitively we're in a bull market on gold. We can call it a deer market or a sideways market. In a bull market, as I often say, overbought tends to become much more overbought, way above the 70 level, or also stay overbought, and you get these persistent readings. See here, you came overbought, you stayed overbought for a while, you got knocked down a little, and you kept going. So the point is, if this is a new bull market, and especially if we break out here, that won't really matter right there. However, if this is not a new bull market, if this is, let's say, some continuation of a very large new secular bear market, and we're going to consolidate here and break down, then that's not a good sign there. So just something to point out. Again, I'd be remiss not to mention that. We've moved up kind of like the stock market, all the way from oversold to overbought in relatively short order. Usually it takes longer to get there once you hit oversold. But again, back here, we were overbought. We had a little correction. We became overbought again. So really, if you're a long-term trader, it didn't behoove you to sell at that first overbought reading. Okay, and back to the daily chart. Again, this was our last trade. We were long here for both fundamental and technical reasons, primarily the breakout. First target hit, second target, third target. And now where we're at, a couple developments worth noting. We do have negative divergence, and I would be remiss not to point this out, and that's why I'm a little cautious. That's one reason I haven't added back the gold trade. I do plan to re-enter, but let's see what happens here. I should point out this is not divergence yet. I have to mention that, technically speaking, because here we made a high right here, and we haven't taken that high out. Negative divergence will come when we equal or exceed that high if we do. So that is one scenario that if gold pops above the recent high and then reverses, it will have put in negative divergence because these indicators are lagging, even if they move up a little. Again, if we pop up and reverse. If we pop up and keep going, then we'll burn through that. So it's just something to point out. And again, what I'm doing here is I'm telling you there's some mixed signals, and it's keeping me cautious and just on the sidelines for now. The other thing to that is you can probably see I have gold in a price channel, or at least above this uptrend line, pretty well defined. And if you put in that high, that divergent high there, we break that trend line, and we'd probably come back here at about that 122.40 level. There's also minor support here, but that's certainly a possibility, and that's not an awful correction, and it is somewhere I would be very interested in going long if the chart's confirmed at the time. So I want to point out these scenarios here, and let's just try to keep it simple. At this point in time, let's just say this is my bearish scenario in gold, and it's still longer term bullish, and my bullish scenarios, we just work through these divergences and keep going. And as promised, here's that 60-minute chart of gold futures. You have, just these trends. These are swing trader time frames, not long-term trend traders. Shouldn't be concerned. But, futures gold trades pretty well to the technicals at times. You have these nice uptrend lines, price channels. There was a downtrend line recently. It was broken, back tested successfully right here. But we've been kind of grinding around in the sideways range. Again, this is where we exited the trade recently, somewhere in here, and kind of sidestepped this. So this is what's going on. And if we just consolidate and then continue on higher, that's healthy price action. A lot like the stock market did a few weeks back when I thought we'd get a decent correction. And it ended up consolidating in time more so than in price, and then made another thrust up. So that's certainly a possibility for gold. But this was another reason why I exited that trade when we did. We had negative divergence at the high as well. And so this, again, almost mirrors what happened on the stock market on the 60-minute time frame too. At that point, we had this strong run up. We had clear negative divergence, but with all due respect, we did have a correction, just like we did in the stock market. It just wasn't very deep. There was your correction in price, and then the rest of it was a correction so far in time, and that certainly has the potential to have worked off whatever needed to be done with those divergences. In other words, they indicate a likely trend reversal or period of consolidation, and that's certainly enough to satisfy those divergences, in my opinion. Okay, I talked up the dollar quite a bit and the importance of tracking the dollar with gold. Yeah, so here's my favorite proxy. You can look at the dollar index. I like watching the euro US dollar pair. The euro is by far the largest component of the US dollar. It's nearly 2/3 of the dollar index. So if you can see where this currency pair is going, you can tell where the dollar is going. And you can see we have it's been just simple wash, rinse, repeat stuff. These were all pointed out at the time, a big divergent low back there, which was bullish for the euro, bearish for the dollar. Remember, when this pair goes up, the euro is going up against the dollar, so it's like looking at the dollar in reverse. The dollar's falling. And this was a large basing pattern right here. We broke out above it with the divergences. That was a sign we'd break out. Back tested it from above, ran up, but at that point, and again, this was also pointed out, we had negative divergence at that high and a nice clean trend line. When that was broken, that triggered a waterfall sell-off. And again, we've come full circle now. That's the whole point of this video. Now we've set up, we've corrected, those divergences have certainly played out for probably as much as they need to. And we've set up in this bullish falling wedge as we've come down. We're inside. I thought we'd bounce off the top of the support, that range before, and I have two lines. There's the bottom of it. Actually, you know what? We're close enough. I always had the bottom of the range here about 113.50 or so. And we're still flirting with the bottom of it, a little bit below it, but close enough to really say that's we're still testing the top, because this wasn't a well-defined range. There was a lot of trading through there. So there it is. You fall into support with divergence. It's not clean divergence, and that PPO isn't really pointing up. The RSI is pointing down. So again, this is why I have some pause right now. But if we can turn around, we'll keep an eye on gold. And if I forget to do an update a week, 2-3 weeks from now, bump me on it, especially if you see gold rising. We might not catch the bottom, but I'd like to jump back in for the next trend trade. If you're a longer term investor right now, again, and I've said it before, I don't see anything in the charts that would really scare me out if, I'm talking a part of your long term funds. And I am a big fan of asset allocation, strategic asset allocation, have money in bonds, commodities, equities, different asset classes, different sectors. That is the key to investing. I know we throw out a lot of swing trade ideas in the trading room. I focus on the broad markets a lot, but that's just a small piece of the pie, and it should not be 100% of anyone's portfolio. All right, so there's the weekly time frame, bigger picture for the euro, and here's what it looks like on a daily chart. We had a divergent low there, right there at that point, and it did play out for a nice rally in the euro US dollar. And we had simply extended those divergences. At that point, we went on to make a slightly lower, almost equal, called an equal or lower low, and that just extends the divergences. So what we need now, whether we could have a little pop below first or not, want to see everything, the euro start to rally against the dollar. I mean, dollar falls, and to confirm these divergences, go on to take out this trend line, and that would be the upside potential. That would be bullish for gold, because it would mean the euro is rising and the dollar is falling. And so bottom line is, my analysis on the euro once again aligns with my analysis, especially longer term. There's no buy signals here yet. Don't get me wrong. This is a bullish setup awaiting a buy signal. Euro's flirting with multi-year lows right now. So we're watching this. The charts appear to me that we will get that trend reversal. Whether it comes, next week or next month or 3 months from now. So that's something to watch. Okay, let's look at the other shiny metals real quick. There's silver. See that you have the divergence right there. You had actually at the highs negative divergence. Silver trend line's not as well defined. Looks like you cracked it, but now we're snapping back above it. So maybe a whipsaw signal there. Silver will roughly move in tandem with gold, not always 1-to-1. I could probably tighten up, change this trend line right there. There it is. This is a weekly chart. Here's a trend line. Let me tighten it up a little bit there. That comes in, captures a lot of reactions. Big level, 1470. Go back for years, all the way to 2014. Look at all the reactions there. 1470 and that downtrend line, that is the magic number. Silver needs to take that out with conviction. Very bullish if it does. If not, a rejection. We'll have the PPO turn back down, trying to cross above the zero line. So we're at, I think, a pretty important inflection point for a lot of these precious metals. And here's PPLT. This is a platinum ETF. It does a pretty good job of tracking. You can draw a lot of different lines. Let's just look at our official trade. We've been in this one for a long time. I've covered it many times since then. We missed our target by just a hair. So for all intents and purposes, it hit my target. I just had it set maybe a little too loose. I thought it was set right, but we missed it by just a hair. So that first trade, well, we hit our first target for sure quickly and then almost hit the second. I mentioned at the time that we had some divergences on the 60-minute. We had this trend line. If that broke, we'd probably see more downside. But, I still like the longer term, and I've left it on. And we're still well above the lows. It looks like it's really holding this support nice and a big move today. We need to get above these highs. That's the bottom line. We need to take out those two previous highs, and that'll open up the door, and then we'll finally go on to hit our target. And I'll probably, at that point, since we've already had the big consolidation after it was hit, I'll go on and probably add some additional targets. Probably, I'll tell you right now, somewhere up here, maybe around that 85.44 level. Palladium. This palladium is PALL. The ETF looks like it's getting ready to give up the ghost, or at least looks that way. This one's gotten ahead of itself, I think. You have a pretty clean up trend line. You just have to see this trend line broken, and we'll get a sell signal. We haven't seen that yet. Divergent high, negative divergence, everything else. I don't know if I have anything on this long-term chart. Yeah, there I do. Trend line, breakdown, back test, but it's above it. We could play around with it a little bit, say it's testing. I don't have a strong opinion, but I just, again, I think palladium's a little stretched. It's more of an industrial metal, a lot of industrial uses, and even now they're ripping off catalytic converters out of cars because palladium has now become more expensive than gold after this big run up. And finally, GDX, everybody's, or at least my favorite trading proxy. A lot of people love this one. Looks like a little bull flag right here. So, for it to play out as such, we're going to need gold to cooperate. But you can see this is textbook. A bull flag consists of a very impulsive move up leading to the formation of the flagpole. And then the breakout, the measured target, you take the flagpole or the length of it and add it to the where it breaks out, and that would give your measured target. Either way, keep an eye on this uptrend line for GDX. It's pulled back to support recently on that flag. I have 2187. I've had that on the chart for a long time. We've had this one it was also an official trade recently. We closed it out here, and it corrected right after we closed it out. And right now, I can't make a screaming case to buy, although I'm watching that flag intently. But again, you break out of that bull flag on GDX. If gold doesn't follow through, or especially if it moves down, that breakout will. And finally, longer term, big picture for GDX looks good. I mean, GDX has gotten ahead of gold on the same, very similar, I should say, symmetrical triangle breakout. Also a breakout above that key 2077 level, which to me was very important. A lot of reactions going back for years. So from a long-term perspective, it looks good. It would be better to see this PPO get above the zero line. But again, the fate of GDX will hinge largely, if not exclusively, on what gold does. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.